Good morning, ladies and gentlemen. Welcome to the Wind Insights Essential Training Series. Today, we are delighted to be here to introduce you to the Wind Financial Terminal. As a comprehensive platform, the Wind Financial Terminal has become an essential tool in the daily work of financial professionals, providing vast amounts of data, analytical tools, and in-depth insights for various financial operations. It covers multiple areas including equity research, bond trading, commodities and derivatives, foreign exchange trading, and fund investment, encompassing nearly every financial scenario you can imagine. Today's topic is Fed's Hawkish pivot, in-depth analysis of interest rates and key data. We will focus on the Federal Reserve's critical policy shift in 2026, thoroughly dissect the logic behind the hawkish signals and their market impact, and help financial practitioners build a systematic framework for tracking Fed policy in a complex macroeconomic environment. Why should we study the Fed policy tracking framework? Because the Fed's decision-making framework has changed. Over the past 2 years, the market has focused on whether inflation has peaked. Now, with the downward shift in the inflation trend, the market's focus has shifted to the balance between inflation persistence and economic resilience. This is what we often refer to as the interplay among the three scenarios: soft landing, reinflation, and recession. Before we officially begin the training, I would like to briefly introduce Wind. Wind was founded in 1998 and is headquartered in Shanghai. It is one of the pioneers and leaders in the Asian financial information services industry. We serve a wide range of institutional clients from over 40 countries worldwide. With a comprehensive product system and data matrix, Wind can significantly enhance your work efficiency. This training session will focus on 2 key areas. First, signals of a hawkish policy shift, and second, analysis of core economic data. Part 1. Signals of a hawkish pivot. What is a hawkish pivot? It refers to the Federal Reserve's inclination to adopt or maintain a tightening monetary policy to curb inflation and prevent economic overheating. The purpose of studying this pivot is to capture the inflection point in policy and seize the front-running opportunity. If early signals can be identified before the official announcement, investors can adjust their strategies or implement risk hedging in advance. The March FOMC meeting released clear and strong hawkish signals, significantly dampening market expectations for interest rate cuts within the year. Simultaneously, we observed that the Fed revised upward 2 core data points: GDP growth to 2.4% and core PCE to 2.7%. This is the underlying logic of the hawkish stance: a strong economy and sticky inflation. Next, we will accurately interpret the core signals of the hawkish shift from 3 key dimensions: dot plot reconstruction, upward revisions to economic forecasts, and changes in policy wording. First, the dot plot. It serves as a crucial window for the Federal Reserve to signal its interest rate cut path to the market. How can this data be accessed through terminals? In the Macro News Express interest rate policy, or by entering GIP in the lower right keyboard wizard, locate the interest rate forecast, which displays the latest dot plot data in real time. The 19 dots correspond to the projections of the 19 committee members regarding the future direction of interest rates. The horizontal axis represents the timeline, namely the next 3 years, with longer run on the right indicating the long-term neutral interest rate, the level that neither stimulates nor restrains the economy, which can be roughly understood as the ultimate target. The vertical axis represents the federal funds rate, typically in increments of 0.25 basis points. The median is 3.5%, considered the mainstream expectation of the Federal Reserve's policy. By comparing the current interest rate with the median forecast, one can roughly estimate the number of expected rate hikes or cuts priced in by the market. The position of each dot represents the midpoint of the interest rate range predicted by a committee member. Observe the degree of dispersion. If the dots for a particular year are relatively concentrated, it indicates a high degree of consensus among members, suggesting a clearer policy path. If the dots are widely scattered, it reflects significant internal disagreement and higher uncertainty about future policy. Additionally, compare historical changes by contrasting the current dot plot with the previous one. If the overall plot shifts noticeably upward, it implies members have become more hawkish. If it shifts downward, it indicates a more dovish stance, meaning a tendency toward interest rate cuts. If one wishes to transform vague monetary policy expectations into quantifiable probability data, they can refer to the FedWatch tool above. This tool is calculated based on 30-day federal funds futures prices. The vertical axis indicates the dates of FOMC meetings. The horizontal axis shows the federal funds target rate range, and the cell data represent the probability of an interest rate cut. The blue area represents the most likely federal funds rate level after the meeting under current market pricing. The orange area indicates the secondary expected probability priced by the market. For example, after an FOMC meeting, the rate cut probability chart might show a 98.2% probability of the rate being in the 350-375 basis points range. By the end of 2025, the market consensus had expected 3 rate cuts in 2026, totaling 75 basis points. However, the latest dot plot directly slashed the median projection for 2026 to just 1 cut 25 basis points, with 4 officials even believing no cuts should occur throughout the year. This indicates the Federal Reserve's current stance is very clear. Internal concerns about inflation rebounding have intensified, while confidence in a soft landing for the economy has strengthened. Consequently, policymakers are inclined to maintain a hawkish stance of higher for longer interest rates. Let's examine this set of data next. The 2026 GDP forecast has been revised up from 2.3% to 2.4%. Core PCE has been significantly raised from 2.5% to 2.7%, indicating that inflation persistence exceeds expectations. The unemployment rate has been slightly adjusted upward, but remains near historical lows. This very dataset is the foundation of the Federal Reserve's confidence in shifting to a hawkish stance. Regarding how to obtain economic forecast data through the terminal, we will now proceed to a practical demonstration in the terminal. Under Macro News Express Monetary Policy, or by entering GMF in the keyboard wizard at the bottom right, you can view relevant data. The Global Macro Forecast product provides market forecasts from various institutions for countries worldwide, assisting financial professionals in quickly accessing traceable and comparable time series data for macro forecast analysis. It covers data from over 200 countries and regions, including 11 macro forecast dimensions such as economic performance, interest rates, balance of payments, employment markets, and fiscal revenues and expenditures, encompassing tens of thousands of forecast indicators and visual charts. The forecast data is sourced from major securities firms, research institutes, and other forecasting agencies, as well as official institutions like the Federal Reserve and the U.S. Department of Agriculture. You can also switch the data display to data bars or graphs and support one-click download and export of the charts. A hawkish shift can also be detected through the wording of policy statements. The reason for studying statement phrasing is that the Federal Reserve's decision-making process heavily relies on data and forward guidance, and the wording of statements serves as the transmission medium between the two. First, the inflation wording changed from progress on inflation to repeated lack of further progress, shifting the tone from positive affirmation to concern. The employment language moved from signs of stabilization to little changed, adopting a more cautious tone that implies greater uncertainty about the future development of the labor market. Finally, the statement noted that the impact of Middle East tensions on the U.S. economy remains uncertain, marking the first time geopolitical inflation risks have been explicitly factored into policy considerations. The second part is core data analysis. We can determine whether inflation is a temporary rebound or structurally entrenched by dissecting core data. Only when data confirms that inflation is sticky will the hawkish pivot move from signal to action. The verification of hard data not only strengthens the robustness of the logic, but also provides confidence and risk control basis for positioning. First, inflation data can be examined via WIND-EDB. Both CPI and core PCE indicators are relied upon by the Federal Reserve for monetary policy decisions. They are also objective data that verifies whether hawkish, dovish stances are factually supported. The CPI inflation rate has passed several key milestones. In April 2023, the year-on-year CPI reached a high of 4.93%, while core PCE remained elevated, marking the peak period of interest rate hikes. By January 2025, the year-on-year CPI had further declined to 2.74%, with core PCE approaching the Federal Reserve's 2% target, formally entering the rate-cutting cycle. In December 2025, the year-on-year CPI stood at 2.68% and core PCE at 2.7%, leading to a temporary pause in rate cuts. Entering 2026, the year-on-year CPI dropped to 2.39% in January, but core PCE remained at 2.7%, showing signs of inflationary rebound. By March 2026, the year-on-year CPI rebounded to 3.26%, and core PCE exhibited an upward trend of 2.7%, sending a hawkish signal. All data is sourced from the economic database EDB. Return to the terminal, enter the macroeconomic DB, and query US, CPI, all items, NSA, YoY, and US, PCE price index excluding food and energy, YoY in the search box. Extract data, set the date range, and generate charts. The system incorporates intelligent computation, offering over 100 common indicator operations and more than 30 data adjustment capabilities. It can automatically perform intelligent alignment of frequency, units, and currency, significantly reducing data processing costs. From the perspective of the target gap, the current C-Parkplatz I still remains 126 basis points away from the Fed's 0% inflation target. Moreover, the recent rise in goods inflation is primarily driven by tariff effects, which represent a one-time shock rather than a persistent pressure. The Trump administration's tariff policies are transmitting inflation by pushing up import prices, but the Fed expects this impact to peak around mid-2026. Once it subsides, that decline will serve as an important signal for the Fed to consider easing monetary policy. If CPI core PCE determines whether the Federal Reserve should raise interest rates, then employment data determines whether the Fed dares to continue raising rates and when to stop raising rates. Looking at the employment market data over the past 3 years, we observe a complete cycle of evolution. In April 2023, the U.S. job market demonstrated remarkable strength, with the unemployment rate falling to 3.4% and non-farm payrolls surging by 241,000 in a single month. During this phase, the policy stance was clearly oriented toward robust employment. However, a turning point quietly emerged in the second half of 2024. Data from July 2024 showed the unemployment rate climbing to 4.3%, while new non-farm payrolls plummeted to 89,000, indicating a clear cooling of the labor market. This trend intensified further in 2025, with the unemployment rate reaching a high of 4.5% in September and new job additions dropping to just 41,000, directly triggering the Federal Reserve's decision to cut interest rates. More alarmingly, December 20 saw negative growth in non-farm payrolls 16,000, marking the official weakening of the employment market. The most salient feature of the current job market is the %, minus %, unemployment rate, which remains at a relatively low level from a historical perspective, providing strong evidence for the resilience theory of the labor market. Although monthly fluctuations exist, new non-farm payroll data have maintained an overall positive growth trend. However, behind the seemingly robust data, changes in 2 key indicators warrant close attention. Firstly, the decline in the labor force participation rate reveals structural issues on the supply side of the labor market. This phenomenon indicates that a portion of the workforce is withdrawing from the labor market rather than actually securing employment. From a long-term perspective, the contraction in labor supply will constrain the economy's potential output capacity, which may become a bottleneck for future economic growth. Second, the marginal deceleration in hourly wage growth conveys a more nuanced signal. A slowdown in wage increases typically indicates a marginal weakening of the labor market, reduced hiring willingness among firms, and diminished bargaining power for workers. Yet this change also carries a double-edged sword effect. It helps alleviate core inflationary pressures, thereby creating room for a potential policy pivot. Taking into account the current fundamentals of the labor market, we can draw a key conclusion. Robust employment plus elevated inflation equals the Fed has grounds to maintain a hawkish stance. Next, we introduce the U.S. Treasury yield curve. The reason for studying it lies in its recognition as both a prophet of the macroeconomy and an anchor for asset pricing. Essentially, we use the U.S. Treasury yield curve to understand the market consensus on the future macroeconomic path and to assess whether current asset prices are reasonable. From the beginning of 2023 to April 2026, the U.S. Treasury yield curve completed a crucial shift from deep inversion to positive steepening. At the start of 2023, the 2-year yield was 100 BP higher than the 10-year yield, a typical signal of recession expectations. Currently, the 2-year yield is 55 BP lower than the 10-year yield, reflecting a significant cooling in market expectations for Fed rate cuts. This change in the shape of the curve generally signals that the market is repricing the resilience of economic growth, or that concerns about a rebound in inflation are heating up again. To analyze and comment on charts, the Intelligent Insights feature integrated into Alice EDB leverages a deep understanding of economic data and graphics. It allows users to customize chart templates, generate visually rich insight reports with one click, and rewrite content in real time using natural language, making analysis production easier and smarter. For example, Alice Insights can automatically generate summaries and commentaries. If you are unsatisfied with a comment or chart content, the AI can help polish it with one click. Click the rainbow ribbon to operate besides expanding, condensing, or rewriting comments and modifying charts. You can also make edits using natural language, such as instructing it to show the latest value. A legend with an ellipsis on the right supports one-click copying of the comment, editing the text, or deleting the entire comment paragraph. When you want to view charts within a report, you can enter dashboard mode to bookmark, download, export, and perform other operations, creating your own customized monitoring screen to quickly identify trends and support efficient decision-making. If you wish to export the entire report, Excel export is supported for easy tracing back to source data. A polished PDF can also be exported with one click, ready for presentation on screen. This is an AI-generated insight report. The system simultaneously generates a corresponding table of contents and related charts. If you wish the report content to be updated automatically, you can return to the terminal and find the scheduled tracking function in the toolbar. This function supports updates according to the cycle you set, such as every Monday or at 9 a.m. on the first of each month, and also supports custom update times. The update method can be chosen as Update Content Only or Update Content and Title. After the report is updated, it is primarily pushed through two channels. First, via system notifications, which appear in the lower right corner of the economic database interface. Second, via email push, which will be sent to your mailbox as a PDF attachment. This concludes the introduction to Alice EDB Smart Insights and Scheduled Tracking. The US dollar index serves as a barometer for hawkish policy. Its fluctuations not only determine the performance of non-US currencies, but also directly trigger a global reassessment of assets, the outbreak of debt crises, and the Fed's passive policy adjustments. The traditional logic of dollar pricing analysis has undergone a fundamental reversal. This is not merely a cyclical fluctuation, but a structural paradigm shift. The previous framework was built on the interest rate parity theory. Fed hawkish policy gives rising U.S. Treasury yields, gives widening interest rate differentials, gives capital inflows into the U.S. dollar appreciation. This logic remained largely valid over the past few decades, but current markets exhibit features completely contrary to the traditional pattern. Hawkish policy now leads to dollar weakness, rising treasury yields coincide with dollar depreciation, and a high interest rate environment triggers recession fears rather than capital inflows. This systematic divergence indicates that the core drivers of the dollar have undergone a qualitative change. What are the underlying driving factors? First, the backlash from tariff policies. The U.S. tariff measures have triggered retaliatory responses from trading partners, leading central banks and sovereign wealth funds to systematically reduce their holdings of dollar-denominated assets. This de-dollarization is not a short-term sentiment fluctuation, but a long-term adjustment in asset allocation. Second, the repricing of growth expectations. Despite the Federal Reserve maintaining a hawkish stance, market expectations for U.S. economic growth have been continuously revised downward. The high interest rate environment is beginning to show its suppressive effect on the real economy, and concerns that excessive tightening could trigger a recession are outweighing the attractiveness brought by interest rate differentials. Third, the restructuring of the global monetary system. Central banks worldwide are accelerating the increase in gold reserves while reducing allocations to dollar assets, marking the most profound adjustment in the international monetary system since the collapse of the Bretton Woods system. This trend is self-reinforcing. Once established, it becomes difficult to reverse. In today's session, we established a monitoring framework for 3 major hawkish policy shift signals. Anchoring decision-making through in-depth tracking of core macroeconomic indicators, using the evolving trends of CPI and core PCE to anchor the policy bottom line against inflation. Employing marginal changes in employment data to define the risk threshold for recession prevention, and anticipating the timing of an economic downturn based on shifts in the U.S. Treasury yield curve. This framework can assist financial practitioners in efficiently identifying trading signals during critical policy transition windows, significantly enhancing the foresight and practicality of investment decisions. Through the brief introduction just provided, we believe you have gained a comprehensive understanding of how to locate functions, information, and data within the Wind Financial Terminal. If you have any questions while using the Wind Financial Terminal, please feel free to press F1 for 24-hour online service support or contact your account manager directly. We will assist you promptly. That concludes today's training and sharing session. Thank you for watching.